Safe Crypto Show disclaimer. Please keep in mind at all times that we, the hosts and guests of the Safe Crypto Show, are not offering or giving investment advice. We only state our personal opinions and thoughts on our own interests. By watching, you agree to not hold us responsible for any losses you may incur by executing trades or by maintaining holds based upon the subjects discussed in our episodes. It is Friday, the 19th of October, 2018. Today I'm joined by my co-host, Mike. Welcome, Mike. We have an interesting show today.
Glad to be here.
Get straight into it here. Got the top 10. Bitcoin still number 1. Ethereum 2. Ripple XRP 3. Bitcoin Cash 4. EOS 5. Stellar number 6. Litecoin 7. Tether number 8. Cardano 9. Monero rounding out the top 10. It's like the big mover in the last 11 days overall is Stellar. It's a big jump up. You can see the Bitcoin dominance at 53.9%. Let's have a look at the 7-day global market cap. Let's see, we started the week at below 200 billion, 198.8, basically about 199 billion. We had a major move up within 2 hours' time. It went zip from 200 billion all the way to 220 billion. That's a heap of a move in 2 hours. Market manipulation much? I don't know. What do you think?
Well, it seems to happen that way before, so
Yeah,
I'm not going to think it's any manipulation, just a lot of people who are speculators all jumping on the same bandwagon.
Just at 2 hours all at once. Well, whether they're speculators, yes, certainly they're speculating, but it just seems quite coordinated. I think either that's a really huge fish to throw that much capital at the market all at once, or it's a coordinated attack. And then immediately after it hits that high, there's a major sell-off of about 10 billion. That's good profit. Continues on, and we've ended the week here at 208 billion. So kind of recovered from our drop last week. We had a pretty major drop, and we've recovered some of that, so that's good. Let's move on to Blocktivity. Got EOS at number 1, BitShares number 2, Steam number 3, Bitcoin number 4, Ethereum 5, Wave 6, Komodo 7, Ethereum Classic 8, Bitcoin Cash 9, Litecoin 10. So we can see unconfirmed transactions on Ethereum is 79,300. So pretty bit higher than normal when we check here. You know, it varies from hour to hour, but that's a bit higher than what it has been at the time we do the show usually. So. And Bitcoin is at 87.3% utilization. So I saw a couple weeks ago it was maxed and had unconfirmed transactions again. So I think, Bitcoin's running into problems and could be higher fees down the track if that trend continues. And I'm assuming it probably will, but we'll find out as time progresses. Let's get into the news then. We've got our headlines for the week. Binance increases anti-fraud measures with Chainalysis partnership. Chainalysis is a company that does analysis of blockchains, of course. Crypto compliance provider and research firm Chainalysis announced it had partnered with exchange Binance in a press release Wednesday, October 17th, in order to improve its detection of suspicious transactions. So there you go. Binance is starting to look a little more closely about what's going on, but I think this is also about KYC, AML stuff. So if you're using Binance, keep that in mind. They are watching you. Little sister is watching you. Our next headline, Apple's Steve Wozniak co-founds blockchain-focused venture capital fund. Apple co-founder Steve Wozniak has been announced as a co-founder of recently launched blockchain-focused venture capital fund Equi Global, a global business outlet, reported on Monday, October 15th. No huge surprise. I mean, Steve Wozniak's a pretty big blockchain supporter, so he's getting involved. That's good. Next, confirmed, Coinbase veteran Adam White has joined ICE's crypto platform Bakkt. The former head of institutional products at major U.S. crypto exchange Coinbase, Adam White, will be joining Intercontinental Exchange's ICE forthcoming platform Bakkt. According to a Medium post published on October 15th, White will be joining as the chief operating officer this November. So it looks like Bakkt, now that's ICE. ICE is I think they own the New York Stock Exchange or something. They're one of the big companies behind one of the big exchanges like that. I'm not sure. I think maybe it is the NYSE, but correct me if I'm wrong, anyone. So yeah, and they've been working on this Bakkt exchange, which is effectively going to be a crypto platform, and now they're pulling in the Coinbase veterans. So I guess they're going to get a little advice. Next in the news, let's see. This is our last headline. In the opportune bear market, crypto merger and acquisitions surge over 200% in 2018. In what has been dubbed a deal frenzy, crypto and blockchain-related merger and acquisition activity has surged by over 200%, according to CNBC, or reported by CNBC on October 18th. Data compiled by JMP Securities for PitchBook reportedly reveals that the total number of M&A deals in the sector is set to hit 145 by the end of this year, with 115 already closed as of October 15th. So, yeah, it's definitely an increase in stuff happening. I guess mergers and acquisitions is an important part of consolidation in a bear market. So once we reach that level of consolidation that people are happy with, we can maybe start to see some growth again, which would be good. Next, let's see, this is our first story I'm going to cover. Cryptocurrency loans company Genesis processes $550 million in first 6 months. So institutional cryptocurrency over-the-counter broker Genesis Global Trading revealed its loans spinoff processed over $500 million in its first 6 months in a new report Thursday, October 18th. Genesis, which began its digital asset lending activities in March, revealed its current order book consists of $130 million in outstanding loans, a figure which has steadily grown since inception, it says. Total cash flow reached $553 million for all supported assets. Over the past year, through client feedback and the rise of derivative marketplaces, we saw a meaningful increase in the number of market participants wanting to borrow and or lend digital currencies. The company summarized about its motivation to move into the loans market. Trends over the first half of a year's trading consists of a reduction in Ethereum loans and a rise in popularity of loans in other altcoin assets in quarter three, with Bitcoin staying consistent throughout. Specifically, Litecoin, Ripple, Ethereum Classic, and Bitcoin Cash all drew higher demand while supply constrained, driving rates on most alternative assets higher. The type of client using the platform has also changed over time, with hedge funds dominating at the start, but since giving way to trading and arbitrage firms. These firms generally borrow digital assets to trade against derivatives like futures and swaps. Genesis said, concluding, "We believe this kind of activity will continue to pick up as derivative markets mature. Quarter 4 2018 is set to see the market debut of at least one major institutional investment solution for cryptocurrencies, likely Intercontinental Exchange's regulated ecosystem Bakkt, which will initially offer physical Bitcoin futures." Now, I just want to point out what cryptocurrency loans can be used for. They can be used for multiple things, but one of the things they can be used for, is short selling. So just have a little graphic up here. Mike, you can't see this. I should have given you the link to it, but I'll just read it out here. So in short selling, step 1, short seller borrows, say, 10 shares of ABC stock. And step 2, short seller sells 10 shares of ABC stock for $500. And step 3, stock loses value. Well, they hope it does anyway, or they manipulate the market to force it to, or to try to force it to. Then step 4, short seller buys 10 shares of ABC stock for $400. And then step 5, short seller returns 10 shares of ABC stock and keeps $100. So that's what this sort of thing can be used for, this cryptocurrency loaning mechanism. So, and these companies in return, they get a fee just for loaning it out in and out of their coffers, I guess. So it helps them, I guess, arbitrage the price differences as well, because they get a fee for that. So it's interesting to see that these mechanisms are developing, and You can argue whether short selling is a good or a bad, but I guess ultimately it is helping to even out and level the marketplace and keep the speculators a little in check. All right, our next story, CME report, Bitcoin futures trading keeps growing in quarter 3, average daily volume up 41% over quarter 2. Bitcoin futures trading at Chicago Mercantile Exchange has continued to grow in quarter 3. The US-based exchange reported in a tweet on Wednesday, October 17th. The CME Group has revealed that the average daily trading volume of Bitcoin futures has increased by 41% in quarter 3 over quarter 2, while open interest, or the number of open contracts on Bitcoin futures, has risen by 19% in the third quarter. Got a little graph there. Let's see, quarter 1, quarter 2, and quarter 3. Pretty nice growth there. Compared to the results of the second quarter over the first quarter, the trading dynamics have now been growing at a slower pace than in quarter 3. On July 20th, the CME reported that Bitcoin futures trading in quarter 2 had seen a large increase, with ADV and open interest up 93 and 58% over quarter 1, respectively. CME Group is one of the biggest global exchanges and the largest options and futures contracts of any futures exchange in the world. The company had also launched Bitcoin futures trading on December 17th, 2017, shortly after the launch of Bitcoin futures by the Chicago Board of Options on December 10th. In early October, crypto analyst and host of CNBC's show Crypto Trader Rand Neuner had predicted that Bitcoin price is about to explode in the wake of the upcoming decision on several Bitcoin exchange-traded fund applications by the U.S. SEC. In his prediction, Neuner compared ETFs with Bitcoin futures, claiming that the expectation of Bitcoin futures contracts allegedly made the major cryptocurrency rally last year from 6,691 to 20,000. Recently, Bloomberg reported that the CME was not planning to introduce futures on any cryptocurrencies other than Bitcoin in the near future. Terry Duffy, chief executive officer of CME, had reportedly revealed that the company should first work on the approach to Bitcoin futures, since it, quote, might have been the most controversial launch of a product, end quote. Earlier this year, the Federal Reserve Bank of San Francisco alleged that a sharp decline in the crypto markets in 2018 had been caused by the Bitcoin futures launch. The bank stated that it considered that the, quote, subsequent fall in price, end quote, after the Bitcoin futures trading did not appear to be a coincidence. Yes, one of the rare moments when I might agree with the Federal Reserve. Okay. Our next story, Ethereum's Constantinople hard fork faces consensus issue in testing. An alleged consensus issue in the testing of a planned hard fork of Ethereum called Constantinople has caused a testnet to be not usable, according to a tweet from Ethereum blockchain infrastructure firm Infura on October 13th. Infura's tweet also advises developers to use other testing networks while the Ethereum developer community is investigating the issue. As reported by multiple Ethereum developers, the hard fork became active on the Ropsten testnet on October 13th. However, the testing reportedly caused a consensus issue on Ropsten, which led Ethereum developer Afri Shoden to state in a thread of tweets following the test that there would be no Constantinople in 2018, adding, quote, we have to investigate. As a clarification, following the strong statement, Shoden noted October 14th that at the most recent Ethereum core developers call, developers had agreed that they would not be able to activate Constantinople this year if there are any major issues on Ropsten. He also added that the next scheduled call on the topic would be Friday, October 19th, today, telling the community to stay tuned until then. We're still tuned. They haven't put anything out as of this moment. The Constantinople hard fork is a system-wide Ethereum update designed to increase the network's efficiency. Earlier this year, Ethereum developer Piper Merriam opened an Ethereum improvement proposal suggesting the idea of a possible Ethereum hard fork to invalidate ASIC miners, which are regarded as highly centralizing. So, yes, people were maybe thinking that Constantinople was going to happen in 2018, and so if you're an Ethereum hodler, something to consider on what's happening there. This Constantinople would help with a lot of problems on Ethereum, and it looks like it may be facing an indefinite delay. All right, now for our analysis this week, our discussion. Important aspects of stablecoins, the difference between pegging, collateralization, and redeemability. This is a bit of a long one. I'm going to try to go through it as quick as I can, so hang in there. Stablecoins have been making the headlines in recent months, attracting big investors tempted by the allure of a non-volatile cryptocurrency. At first, we usually pay attention to the backing connection, in other words, to the coin's stabilizing mechanism. Broadly speaking, this is broken down into three categories: asset-backed, crypto-backed, and non-backed stablecoins. So this is part of a great way of introducing the concept of stablecoins and a good basis for providing an overview, but it doesn't paint a full picture in terms of how the composition of stablecoins can ultimately affect its utility and usability. To do this, we need to include three additional but equally important aspects into stablecoin discussions: pegging, collateralization, and redeemability. The three aspects provide a more rounded explanation of how stablecoins work, how they are constructed, and how their utility and usability ultimately depend on it. Pegging. What is pegging? Pegging is commonly associated with the world of foreign exchange, where the currency of one country is fixed or pegged to that of a country with a more stable economy. The main goal of currency pegs is to bring stability to more volatile economies, but it's also a beneficial mechanism for trading partners to make exports more competitive while keeping import costs down. Currency pegs stem from the gold standard that originated in the early 18th century England and the Bretton Woods Agreement that was implemented after World War II. Under this agreement, most Western European countries fixed or pegged their currencies to that of the United States, who in turn pegged the US dollar to gold. Although the agreement was finally dissolved in 1973, it was very effective in the post-war era to stabilize economies and promote growth. With cryptocurrencies today, we see the idea of stablecoins such as USD Volt, TrueUSD, Tether, Circle, Gemini, and Paxos Standard pegging one-to-one to a steady fiat currency like the US dollar. But the phenomenon is also still present in a traditional economy. Many countries use pegging to fix their currency, most commonly to either the US dollar or euro. Very rarely, though, it is one-to-one. Examples include the Hong Kong dollar, pegged to the US dollar at a rate of 7.75 to 7.85, and the Danish krone pegged to the euro at 7.46. And there's different types of pegging. There are different types of pegging mechanisms, and not all pegs are 100% fixed. There is a crawling peg, which is a fixed exchange rate, but one that is allowed to fluctuate between the par value of the pegged currency and a range of predetermined rates. The par value may be periodically adjusted to account for inflation and other market conditions to increase stability. This allows an exchange rate to adjust over a period of time instead of a sudden currency devaluation. A commonly referenced example refers to Mexico, which implemented a crawling peg against the US dollar in the 1990s. This allowed it to gradually devalue its currency, hence the term crawl, over time, until it reached an acceptable exchange rate, thereby avoiding economic instability associated with dramatic currency devaluations. Adjustable peg. An adjustable peg is also a fixed exchange rate, but one that has a predetermined level of flexibility built into it, normally between 1 and 2%. If the rate moves beyond this range, the central bank will intervene to bring the rate back to the target peg. The goal is to allow a country to stay competitive in the export market. Many developing Asian nations have been known to operate such an exchange rate regime in the past, including Indonesia, Malaysia, the Philippines, and South Korea, to restrict the degree of fluctuation toward the dollar and to allow cheap exports. And the basket peg. With a basket peg, a currency will be pegged to more than one currency in a weighted mechanism, comprising currencies of its most important trading partners. The reason a country might use a basket peg is the same reason an investor would diversify their portfolio, to make the currency even more stable and hedge against the risks a single peg currency might face when the anchor currency suddenly devalues, such as high inflation. Examples here include the Chinese RMB, which is pegged against a basket of 24 different currencies, and the Fijian dollar, which is pegged against 5 different currencies. A commodity peg. Currency can also be pegged to a reliable commodity such as gold. For many years before World War II and the Bretton Woods Agreement, the gold standard was widely used to stabilize currencies. However, governments and economists believe the practice can actually stifle growth. Although central banks might still hold some gold as a form of backing, the last currency to decouple from gold was the Swiss franc in early 2000. Yes, although some economists, yes, not all economists believe that, but some economists, the Keynesian-type economists, think that it's a bad idea. Please do your own homework there. Many cryptocurrencies have been designed with a gold standard style mechanism in mind, where one token would be backed by a specific quantity in gold, such as digits and 1 gram, for example. That has mixed results because for investors, prices of commodities are not a relevant unit of account. It doesn't necessarily have to be gold. Though Venezuela launched the petro, an oil-backed cryptocurrency pegged to the price of barrels of Venezuelan crude oil. Well, so they say. So the next thing, collateralization. What is collateralization? Collateral is defined as, quote, to offer an asset as a surety that a debt will be repaid. Basically, it's the asset that the borrower leverages to secure a loan from the lender. The most common example we'll all be familiar with is mortgages, where the bank customer is able to obtain a loan to buy a house based on the provision that the bank may repossess the house if the customer defaults on their repayments. The house serves as backing or security on the loan and reduces the lender's risk. The same principle can be applied to car financing, buying jewelry or art. Businesses can also leverage their existing equipment to obtain financing. With stable coins, the collateral refers to the commodity or fiat that they hold. For every fiat collateralized token a platform issues, they should hold an equal amount of fiat currency as collateral. But this is not always the case, as we'll see later. The same goes for commodity-backed assets. For every token a gold-backed stablecoin platform issues, they should hold an equal value of physical gold as collateral, but again, this does not always happen. The difference between backing and collateral. When a currency is backed by another commodity or asset, it does not necessarily mean the holder of the currency has that surety to exchange it or have a claim on the backed commodity. If we look at the Venezuelan petro example above, a holder of petro tokens cannot exchange it for a physical barrel of crude oil. However, it does mean that the physical barrels of crude oil are held in reserve to stabilize the cryptocurrency and to give it a fixed exchange rate. It's the same principle with gold-backed currencies, where physical gold might be held in reserve to back the currency and to stabilize it, but holders of the currency do not necessarily have a claim on the physical gold, only that they can redeem their currency at a fixed exchange rate against the gold. Collateralization is different, though. As Investopedia states, collateralization occurs when a borrower pledges an asset as recourse to the lender in the event that the borrower defaults on the initial loan. End quote. That means in the case of collateralized cryptocurrencies, the holder of such a coin has an actual claim on the collateral. They can exchange it directly for its value in gold, US dollars, or even other cryptocurrencies. Level of backing. Most asset-backed stablecoins will claim to be fully backed by the underlying asset. However, understandably, these claims are subject to be scrutinized unless backed up by unbiased third-party auditing entities. One of the most famous stablecoins, Tether, has been under fire for months since they parted ways with their auditor and have not been able to provide conclusive evidence that they hold 1-to-1 US dollars in reserve for every US dollar Tether that they issue, and therefore might be severely under-collateralized. Other stablecoins like Saga are actually backed by a fractional reserve, i.e. they don't hold the entire backed asset in physical reserves, and pegged to the International Monetary Fund's SDR, special drawing rights, an international reserve asset. On the other hand, a gold-backed stablecoin such as USD Vault is fully collateralized, meaning the physical gold reserves to back issued tokens are held in vaults which are transparently audited to make sure the stated value of gold actually exists, and a hedge mechanism is in place to maintain 1-to-1 US dollar price stability. It is also possible for stablecoins to be over-collateralized. This is often the case when the actual collateral is another cryptocurrency, like with BitShares, BitUSD, and BitCNY, it's a Chinese yen, and MakerDAO, the DAI token. The issue with crypto-backed stablecoins is that the underlying asset can be just as volatile as the actual coin. So to counter that, the stablecoin will be over-collateralized sometimes as much as 200%, so that when the backing cryptocurrency falls 25, 50, or even 75%, there is still more than 100% of the value left to keep the price of the stablecoin from fluctuating. The important thing to determine is that whether we are talking about the backing of a stablecoin or securing a loan, is the underlying asset adequate and reliable enough to achieve its purpose, i.e. to act as a security or to maintain stability. Next, redeemability. Redeemability is closely related to our previous discussion on backing and collateralization. When a stablecoin is backed by a certain asset, it does not necessarily mean that the holder can redeem their token in exchange for that underlying asset. If we look at Tether as an example, it's backed 1-to-1 by US dollar, but not directly redeemable for US dollar. On the other hand, True USD, a stablecoin designed on the same basis, i.e. backed 1-to-1 by the US dollar, is in fact redeemable 1-for-1 with the US dollar. In more traditional financial markets, the question of redemption is very valid in bankruptcy law and dictates certain conditions that have to be met before an individual can actually redeem their claim on an asset, for said asset. Basically, unless explicitly and unambiguously stated, when a currency is backed by an asset, the user should not assume that they automatically have a legal claim on that asset. There are various benefits for asset redeemable stablecoins, one being that it serves as a confirmation in itself that the underlying collateral actually exists, that it's not a baseless claim. It also provides practical use cases to users, such as, in the case of gold-backed stablecoins, not having to convert fiat for redemption, and therefore avoid exposure to currency fees and price fluctuations. Conclusion. As the market matures, stablecoins are becoming a more prevalent presence in the cryptocurrency space. New investors are continually looking to get into the crypto market, but at low risk and high security, while seasoned investors are looking for options to stabilize their portfolios and a safe haven in case of severe market downturns. This continued search is sure to bring up some interesting mixing and matching of pegs and backings. Who says you can't have a stablecoin backed by Ether and pegged to the Japanese yen? Ethereum founder and cryptocurrency influencer Vitalik Buterin had the following to say on the need for effective stablecoins. Quote, "Are stable value assets necessary? Given the high level of interest in blockchain technology, coupled with disinterest in Bitcoin the currency, that we see among so many in the mainstream world, perhaps the time is ripe for a stable currency or multi-currency systems to take over." So I hope that's helped people understand a bit more about stable coins and all the variations that can come into play with a stable coin. They are not all created equal, so I hope this helps you understand the differences and maybe better evaluate which one you might be interested in, if any. All right, our next topic is the MaidSafe update. So this week, in the summary, they have some things to highlight. The first version of the crust test will be going offline tomorrow morning. Actually, that was yesterday. And before releasing the next test, we'd like to work on a couple of improvements in order to increase the information returned from the test. Next, SAFE-Fleming, that is their Alpha 3, is our new name for Alpha 3. Oh, they just saw me being redundant. I should have said that. And the next item, next week, Doug Campbell will be, he's the one of the main marketing people at MaidSafe, will be heading across to Berlin for the Web3 Summit. So if you're going, please say hello. Next, user M3 Data is running a survey to gauge interest in a Safe Network Sydney meetup. It'll be Sydney, Australia. And finally, the routing team estimates they have tackled around a third of the kinds of malice they detected during their brainstorming. By detected, they mean they considered. So, yes, I'm not going to get into this update directly, but I am going to go over the SAFE-Fleming. They published an article in Medium, and I'm going to read through that next to give an idea about what's coming up. So, but there is in this update discussion on the release of the crust test, a marketing update, Safe API and apps section. They've got a Safe client library section, a routing section, and a crust section. So lots of updates in there this week, folks. And if you're interested in what's going on at MaidSafe, please do have a look. The link is in the show notes to this update link, or you can just go to safenetforum.org and have a look yourself. Okay, so SAFE-Fleming. He's calling that their next major milestone. Well, it is. It's Alpha 3. So let's see what they have to say. In September 2017, we released the Alpha 2 version of the Safe network. It marked significant progress for the project for a number of reasons. We now had a network in which a user's credentials could not be read or misused by a rogue application or even the network itself. The creativity of the Safe network community was unleashed with a wave of activity as people experimented with creating new websites in minutes, and we all experienced just how fast and powerful a truly decentralized network could be. Since then, the team have been working on the next goal, building the technology for Alpha 3. Whilst we've discussed the details in different posts and forum conversations as we approach this next major milestone, that we codenamed Fleming internally, after Sir Alexander Fleming, the noted Scottish Nobel Prize winner from Ayrshire who discovered penicillin, it feels like a good time to revisit exactly what it represents. It in Alpha 3. With an upcoming series of posts on our journey to this next major milestone, we'll not go too heavy on the technical details here. You'll find those details on the forum, DevHub, and DevForum. Instead, we will focus on what each development means, what it does, and most importantly, why the technology and levels of security that it introduces is an essential part of any new, truly decentralized internet that thrives in the permissionless wild. So why is SAFE-Fleming so important? With this next release, you'll get to see all of the innovative components that we've been building over the past year or so in action, bringing two key benefits for everyone: security and scalability. At this stage, the network will be decentralized and resilient, powered by the resources of individuals. Anyone with a computer and internet connection around the world will have the opportunity of joining the network, and by running a node, you'll see fully encrypted transient data moving across the network. As we progress through the next series of releases, it will become obvious just how powerful the technology is. You'll see computers on the network communicating using Crust, punching through the firewalls and routers that stop other technologies. We'll be making it easier for people to understand our groundbreaking ABFT consensus mechanism, Parsec, as we complete its implementation across the network. The SAFE network is permissionless. No one can be prevented from joining. Watch the network respond to malicious nodes seeking to subvert it. Look out also for node aging, the way in which the network autonomously prioritizes nodes that have been proven to be trustworthy over time, creating a vital defense against Sybil attacks and other attempts to game the system. And, as if that wasn't enough, we'll also be implementing significant advances that continue to challenge many projects in the decentralization sphere. With dynamic membership, you'll see the network let nodes join and leave freely whilst ordered consensus is maintained. And with disjoint sections, we will be not only showing how sharding is possible, but delivered and working, way ahead of the multi-year roadmap that blockchain-based projects are facing in this space. You'll also see the network solve the problems of secure communications between different shards. We call this secure message relay, and it's another problem that is still to be solved by the largest decentralized crypto projects in the world. So as we approach SAFE-Fleming, we'll be releasing code which in aggregate will solve many of the problems that remain unsolved for many of the other decentralized projects out there today, and creating a secure network that solves the well-known problems of scalability and security. You can see why we're getting excited. The launch of SAFE-Fleming. With each of these components in place, we'll be good to go. At that stage, you'll be able to run your own node from home and be part of a truly decentralized network. Exciting times. But of course, there's no rest. At that stage, we'll be adding vaults on top of this, technology that we've already demonstrated works in the past, before introducing Test SafeCoin and carrying out essential final security audits and a few other things that you'd expect before any version 1 beta release. I don't say beta there, but version 1, they're talking beta, I believe, of the software. A significant amount of both research and code has already been completed for components of this major milestone. We have a range of teams working across different work streams in parallel, and every delivery along the way should make it clear, whether you're running the code yourself or just reading the post, just how important and how powerful each release will be for the future that we all want to live in. Finally, we're happy to announce that tomorrow, on the 17th of October, we'll be delivering the first part, a Crust test that will allow you to use your home computer to discover and connect to others by testing hole punching in a real-world setting so that people can immediately get involved with the SAFE network. Watch out also for the next post in this series with more detail about what Crust is and why it's so important. So please do join us on what will become an increasingly exciting journey with every new release. You can, of course, in between times, check out the weekly Thursday dev updates on the SAFE Network forum. And as ever, thanks all for your support. So I've given that my 50 claps there on Medium. Please get on Medium and check out this article and give it lots of claps and get it more attention, the attention it deserves. The SAFE Network is highly underrated. Really, it should be in the top 10. I think it's not, because a lot of investors are thinking, well, it's probably a year away, at least from beta, so they have other things to do with their capital. But I guarantee you, if you're a hodler, pay attention, because I guarantee you that once it gets close to beta, it's going to zip up into the top 10, because all those investors who do know about it, but who are just holding off because there's no point in investing in it right now, are going to be dumping their capital into it. It's going to make a huge splash when it finally gets released. Okay, well, that's all I have for today. Mike, you've been kind of quiet today. Any thoughts you have?
Well, as far as for our big debate thing on the stable coins and stuff, the one thing that I keep in mind whenever I'm actually thinking about that particular situation is with any stable coin that has a low volatility and stuff. The value of those is based on your intent to return it from crypto back to fiat. And if you never intend to change it back to fiat, then the fluctuation you'll realize is not in, the fluctuation is not in the crypto, but in the fiat. And it's just something that,
Well, this past week we saw some big out of whack moves with stable coins, particularly with Tether. I think it went down to briefly. I've heard, I haven't seen the data myself, but I've heard that it briefly went down as low as 85 cents on the dollar. It quickly came back up to like 95 cents or so, but it was still way out of whack for quite a while, and something very peculiar there. I mean, it's still today at number 8 on the coin market cap, so it still has a huge percent. It is the top stable coin. I don't know why. I guess people like to keep using what they're familiar with, but there are other tokens out there that are more stable. Several stable coins were affected by this when it happened the other day. One that was least affected was the DAI token, which isn't backed by anything. It's just a mechanism they have in the Ethereum blockchain that causes people to buy and sell it, and create. I think it actually creates more tokens and then destroys tokens or something. I'm not really sure how it works, but it's not actually backed, and it actually did the best of all those. But then again, it's got pretty low volume, so maybe whatever happened with these, whether it was an attack, I don't know. It's pretty bizarre though what happened. So yeah, there's a lot to know and understand, and I don't claim to understand much of it, but hopefully this article made some of the differences between the stablecoins a bit more clear. All right, well, I guess that's all we have for today, folks. I'd like to thank all our viewers for joining the show, and we hope you found the episode informative and helpful. Please subscribe, like, comment, and share our video with others, and tune in next week for another interesting episode. Bye-bye.
Have a good one, everyone.